The global banking system often appears strongest when hidden weaknesses are quietly expanding beneath the surface. Record profits are announced while purchasing power for ordinary citizens steadily declines year after year. This contradiction has appeared many times before major financial disruptions in history. Stability on paper has repeatedly masked structural fragility in reality. Banks are trusted institutions because they symbolize security, regulation, and permanence in modern society. Most depositors rarely realize that their money is largely circulated through loans rather than stored in vaults. Confidence, not cash reserves, forms the invisible backbone of daily banking operations. When confidence weakens, even well-capitalized institutions can struggle to survive. Modern bank branches display polished interiors, digital efficiency, and professional branding that reinforce public reassurance. Throughout history, financial crises rarely began with visual signs of disorder or panic. Instead, instability usually grew quietly within accounting systems and credit markets. The calm exterior often delayed public awareness until pressures became unavoidable. Economic collapses do not arrive with advance warnings or official countdowns for citizens. They typically begin with subtle shifts in bond markets, interest rates, and credit availability. These early signals remain invisible to most depositors focused on daily financial routines. By the time headlines appear, the underlying imbalance has often existed for years. Governments offer deposit insurance programs to strengthen trust and prevent widespread bank runs. These guarantees depend heavily on the fiscal strength and borrowing capacity of the same governments. When sovereign debt levels rise significantly, the credibility of those guarantees becomes more complex. Public reassurance therefore rests on intertwined financial foundations rather than isolated safety nets. Financial markets frequently interpret rising bank stock prices as evidence of institutional strength. Market optimism, however, has historically misjudged risks during prolonged credit booms. Share values can increase even while asset quality quietly deteriorates beneath balance sheets. Perception often moves faster than underlying financial reality. The illusion of safety in banking can be compared to a massive dam holding back enormous water pressure. From a distance, the structure appears immovable, yet microscopic cracks may slowly widen over time. These cracks represent debt imbalances and declining asset values that remain unseen by the public. When pressure exceeds design limits, consequences appear suddenly rather than gradually. Modern banking operates under fractional reserve principles that allow institutions to lend most deposited funds. Only a small percentage of total deposits exist as physical currency within the system. This mechanism supports economic expansion by increasing credit availability and liquidity. At the same time, it introduces dependence on continuous confidence and repayment flows. Credit creation functions like adding fuel to an economic engine that drives consumption and investment. When credit grows faster than productivity, the engine begins to overheat rather than accelerate efficiently. Debt obligations multiply while real income struggles to keep pace with repayment requirements. Over extended periods, this imbalance produces structural financial stress. Liquidity refers to the ability of a bank to meet immediate withdrawal demands from depositors. Solvency refers to the overall value of assets compared to long-term liabilities and obligations. A bank can appear solvent on paper, yet face collapse if liquidity suddenly disappears. This mismatch has triggered numerous historical banking failures. Central banks act as lenders of last resort during periods of severe financial stress. Their emergency funding prevents immediate collapses and restores short-term confidence in markets. However, these interventions often expand monetary supply and increase long-term debt exposure. Stabilization today can sometimes transfer pressure into the future. Interest rate cycles play a decisive role in the health of modern financial institutions. When rates rise quickly, previously issued low-yield bonds lose significant market value. Banks holding large bond portfolios experience unrealized losses that weaken balance sheets. These losses remain hidden until assets must be sold to raise liquidity. Regulatory frameworks such as Basel capital requirements were designed to strengthen institutional resilience. Despite these safeguards, financial innovation continually introduces new forms of leverage and risk. Regulations often respond to past crises rather than anticipating future complexities. As systems grow more intricate, transparency becomes increasingly difficult to maintain. Debt expansion resembles constructing additional floors on a skyscraper without reinforcing the base structure. The building appears impressive and stable until foundational pressure exceeds engineered limits. Economic growth fueled by borrowing can mask the gradual accumulation of vulnerability. When stress arrives, the visible collapse seems sudden, though the cause developed slowly. In the early 1930s, more than 9,000 banks in the United States failed during the Great Depression. Depositors lost billions of dollars before federal insurance protections were introduced in 1933. Excessive speculation and rapid credit expansion during the 1920s created unsustainable leverage. Confidence evaporated quickly once asset prices began to fall. The Asian financial crisis of 1997 began with the devaluation of the Thai baht and rapidly spread across Southeast Asia. Banking systems weakened as foreign-denominated debt became increasingly difficult to repay. Currency collapses triggered capital flight and economic contraction across multiple nations. The crisis demonstrated how interconnected global finance had become. Iceland experienced a dramatic banking collapse in 2008 when its three largest banks defaulted within days. Their combined liabilities exceeded several times the country's entire gross domestic product. Rapid expansion and foreign borrowing created unsustainable leverage levels. The nation faced currency devaluation and deep economic recession as a result. The global financial crisis of 2008 exposed leverage ratios exceeding 30-1 within major investment banks. Governments and central banks injected trillions of dollars to prevent systemic collapse. Mortgage-backed securities and derivative exposure amplified losses across continents. Confidence returned slowly after unprecedented monetary intervention. In 2013, Cyprus introduced bail-in measures requiring large depositors to absorb part of banking losses. This policy revealed that deposit safety could depend on regulatory decisions rather than absolute guarantees. Capital controls and withdrawal limits were temporarily imposed to stabilize the system. The event reshaped global understanding of depositor risk. Each historical banking crisis followed a familiar sequence of rapid credit growth followed by sudden liquidity shortages. Asset prices inflated during optimism and collapsed when sentiment reversed. Policy responses often involved expanding money supply to restore confidence. These cycles demonstrated repeating financial patterns rather than isolated anomalies. Today, global sovereign debt exceeds global economic output by a substantial margin. Governments rely heavily on borrowing to finance spending and economic stimulus programs. Rising interest rates increase the cost of servicing this debt burden. Fiscal flexibility becomes limited during economic downturns. Inflation reached multi-decade highs across several major economies in the early 2020s. Savings held in bank accounts lost real purchasing power despite unchanged nominal balances. Depositors felt gradual erosion rather than sudden loss. Inflation acted as an invisible transfer of value across society. Banks worldwide hold large volumes of government bonds as traditionally safe assets. When interest rates increased, the market value of these bonds declined sharply. Unrealized losses accumulated quietly within financial statements. Visibility emerged only when institutions required liquidity. Commercial real estate markets began showing stress as remote work trends reduced office demand. Loan defaults in property sectors directly influenced bank balance sheets. Rising borrowing costs intensified pressure on developers and landlords. Financial exposure extended beyond visible property values. Central bank balance sheets expanded dramatically after 2008 through quantitative easing policies. These programs injected liquidity into markets and lowered borrowing costs. Long-term monetary supply increased as a consequence. The strategy postponed crises while increasing future complexity. Digital banking accelerated the speed of financial transactions and withdrawals worldwide. A bank run that once required physical queues can now occur within hours online. Information spreads instantly through social media and digital networks. Confidence, therefore, moves at unprecedented speed. Deposit insurance schemes provide reassurance but cover only limited amounts per account. Large institutional deposits frequently exceed these protection thresholds. Governments must balance fiscal capacity with guarantee promises. Trust relies on both perception and economic strength. Global financial systems are deeply interconnected through trade, currency markets, and investment flows. Stress in one major economy quickly influences others across continents. Banking crises rarely remain isolated events. International coordination becomes essential for stabilization. Complex regulation strengthened banks after previous crises, yet also introduced layers of opacity. Complexity can obscure straightforward risks hidden within technical frameworks. Transparency becomes harder as systems grow more sophisticated. Simple imbalances may hide behind intricate structures. If debt continues growing faster than income, repayment burdens intensify for governments and households. Interest expenses consume larger portions of national budgets over time. Economic growth slows as financial resources shift toward servicing obligations. Fiscal resilience gradually weakens. Banks under asset pressure often reduce lending to preserve capital and regulatory ratios. Restricted credit availability slows business expansion and consumer spending. Economic contraction can follow prolonged credit tightening. Financial cycles therefore influence everyday economic life. Inflation quietly reduces the real value of savings while maintaining numerical account balances. Depositors may not immediately perceive the gradual erosion of purchasing power. This process spreads financial adjustment across society rather than concentrating losses. The effect accumulates over long periods. Governments frequently choose currency devaluation instead of allowing widespread bank failures. This approach distributes economic pain gradually rather than instantly. Exchange rate weakness raises import prices and inflation. The burden becomes diffused rather than concentrated. Capital controls and withdrawal limits have appeared in multiple historical crises. These measures aim to prevent sudden capital flight and stabilize liquidity. Temporary restrictions can protect institutions during extreme stress. They also highlight the delicate balance between freedom and stability. Bail-ins remain legal mechanisms in several jurisdictions following regulatory reforms after 2008. Large depositors may share losses if bank capital proves insufficient. This strategy reduces reliance on taxpayer bailouts. Responsibility shifts toward private stakeholders. Slow financial erosion often feels less alarming than dramatic collapse, yet produces comparable long-term consequences. Gradual purchasing power decline reshapes living standards over decades. Citizens adapt without noticing incremental change. The cumulative effect becomes visible only in hindsight. Economic stagnation frequently follows periods of excessive debt accumulation. Growth becomes difficult despite stimulus and policy adjustments. Productivity struggles to offset financial obligations. Recovery requires structural rather than temporary solutions. Monetary stimulus can delay financial crises by injecting liquidity into strained systems. Repeated stimulus, however, increases overall debt obligations and currency supply. Short-term relief may create long-term challenges. Balance between intervention and restraint becomes critical. Financial markets react strongly to expectations and sentiment rather than purely numerical data. Fear spreads faster than reassurance during uncertain periods. Investor psychology influences asset prices and liquidity flows. Confidence, therefore, acts as an invisible economic force. Reserve currencies have shifted throughout history from the Dutch guilder to the British pound and later the US dollar. These transitions unfolded gradually across decades rather than overnight. Economic dominance and trade influence shaped currency leadership. Monetary history reflects geopolitical evolution. Financial literacy provides individuals with tools to interpret economic signals without panic. Awareness replaces uncertainty with informed preparation and rational decisions. Understanding credit systems reduces vulnerability to misinformation. Knowledge acts as a stabilizing asset. Modern banking continues to function daily because public confidence remains largely intact. Systems endure longer than pessimists predict, yet adapt faster than optimists expect. Stability depends on continuous balance rather than permanence. Economic resilience arises from awareness and adjustment. The ultimate lesson is not that banks are destined to fail, but that solvency is dynamic rather than fixed. Financial stability resembles a balance that must be maintained rather than a structure that can be stored. Depositors who understand this perspective see patterns instead of surprises. Awareness transforms uncertainty into informed vigilance.